Dividend investing can be quite a lucrative strategy over the long term, providing you both capital appreciation and dividend income. However, when it comes to investing in these dividend stocks, there are some very common mistakes I see, especially with beginner investors, but even with more advanced investors, and I want to address those things today in this video. Now guys, this is a knowledge-packed video, so smash that like button, sit back, relax, and let me know in the comment section down below if you have made any of these following mistakes that I'm about to cover. So the first dividend mistake that I've seen out there is that the starting yield is too low. Let me explain. So like I said, this is the most common mistake, and it happens to the best of us out there. When you're a brand new dividend investor and you're looking through all these stocks, trying to pick one to invest in, the first and probably the most important thing that you're going to be looking at is the starting yield on these stocks. Most investors, from my experience, want to see a starting yield of around 3% or above to even consider investing in that stock. For whatever reason, that seems to be the sweet spot, so that's what we're going to go with today. What I've also noticed is that if you find a stock in, say, the 1% range, even the high 1%, typically investors will overlook that because the starting yield is just not good enough. And this right here is a huge mistake, because the starting yield is nowhere near as important as the compounded annual growth rate, or CAGR for short. The CAGR pretty much tells you how fast the company is growing their dividend year over year, and this is extremely critical if you're planning to buy dividend stocks, especially for the long term. So now what I thought was, we'll go through a real world example here, look at two real stocks that are trading right now in the stock market, and we're going to compare them, and we're going to try to figure out which one is the better dividend stock. So the two companies that I'm going to compare are Leggett & Platt on the left hand side here, and Lowe's on the right hand side here. Leggett & Platt is currently at a starting yield of 4.1% with a CAGR of 4.14%. Lowe's, on the other hand, has a starting yield of 1.8% and a CAGR of 18.36%. Clearly, you can see that Lowe's offers less than half the starting yield of Leggett & Platt. So right away, the first mistake a new dividend investor will make when looking at this information is disregard Lowe as a possible investment. I mean, who wants to have a dividend stock that pays less than 2% yield, right? Well, stick around, because I'm going to show you right now exactly why you will want to invest in Lowe's in this situation versus Leggett & Platt. Keep in mind from this information that Lowe's actually has a CAGR that is 4 times that of Leggett & Platt, meaning they will grow their dividend much quicker on average. So the best way to illustrate this is to compare a theoretical $10,000 investment and how it performs. Now after the first year, no brainer here, Leggett & Platt returns $415 in dividends, whereas Lowe's returns only $179 in dividends. So as you can see, Leggett returns more than double the amount of dividends here than Lowe's. Now this is clearly a pretty drastic difference here when it comes to dividend yields, but after only 1 year, the CAGR benefit hasn't kicked in yet. So let's move on to the next metric here. After 3 years, Leggett yields you around $468 versus Lowe's $295. And now all of a sudden, you can see that the gap is starting to close down. Leggett isn't yielding double the returns anymore when compared to Lowe's. After 5 years, this gap has closed down even more, with Leggett yielding $508 and Lowe's yielding $413. So we're getting very close to an equal payout here after just 5 years. Now after 7 years, this is where the magic of CAGR really kicks in. Leggett is now yielding us $551 and Lowe's is yielding us $579. So in this situation, after 7 years, Lowe's is now yielding us more dividend income. And from this point on, it's pretty much Lowe's that's the clear winner here, as you can imagine. The growth rate just keeps snowballing and compounding. 10 years, the difference is now about $340 in favor of Lowe's. After 15 years, it's a massive difference, with Leggett at a measly $762 and Lowe's at $2,232. And then if you hold this for even longer, 20 years, you see Lowe's yields you over $5,000 a year, and 30 years, it yields you almost $28,000 in dividends every single year. Now, of course, this information is hypothetical. I did use real-world examples of the prices, the yield, and the growth rate, but when you're looking at a stock over 30 years to have such a high dividend growth compounded rate, is pretty unlikely. That doesn't mean it is impossible for Lowe's to continue growing at an 18% clip year over year for the next 20 years, but what I'm saying is that it is unlikely, so I would set my expectations with that in mind. But what I did want to drill through in this video with this comparison here is that it's very important to consider the compounded annual growth rate, the CAGR, when it comes to dividend investing. After looking at that information, it's very clear that the CAGR is more important than the starting yield. However, there is an exception. If you do plan to hold a stock only for the short term, say only for 1 or 2 years, then clearly Leggett & Platt for this example would have been the better choice because you're not really taking advantage of that long-term compounding effect. And that's completely fine because everyone has different incentives, different strategies, different goals. And if this meets your goal, if you want to only hold a stock for a couple of years, clearly you want to look more at the starting yield as opposed to the growth rate. But when it comes to dividend growth investing and you want to invest over the long term, it's clear here that the CAGR is more important than the starting yield. Now moving on, the second dividend investing mistake that I want to cover here is that investors look for high yields when it comes to dividends. More specifically, I see more often than not people looking for starting yields that are well over 10% and they'll only invest in stocks that pay out over a 10% yield. And as we saw in the previous example here, this is kind of related to that. But you can see that over the long term, you can have your yield on cost be over 10% from your initial investment. But to find a stock, a proper blue chip company that's stable, secure, and growing their dividend year over year, have a starting yield of over 10% to begin with is extremely rare, and if it does happen, there are some things to watch out for. So REITs are actually a very common investing vehicle here where people go in and purchase these REITs because they pay out by law 90% of their income, which typically means that these REITs pay out over a 10% yield. However, during tough economic times, these REITs most likely will slash their dividend and as a result will most likely have a negative effect on your investment. And what's worse is that these type of companies are also more likely to go bankrupt in a recession if times get really tough. So it's also something to consider because you could potentially lose your principal investment as well. I would personally consider REITs pretty high risk investments, and I personally would not allocate a very large portion of my portfolio to them. Now that doesn't mean that you shouldn't invest in REITs at all. I'm not a financial advisor. I'm not telling you what you should and shouldn't do. But it does make sense sometimes to diversify yourself a bit if you don't have any exposure to real estate. Now, if you are investing in high dividend stocks that are not REITs, you should definitely familiarize yourself with something called a payout ratio. And all this does really is it tells you how much a company is paying out in dividends compared to their earnings. Ideally, you want this number to be as low as possible because that does signify the dividend is a lot more sustainable and the dividend is safe from getting cut anytime soon. If this number is high, for me anything above 70% will be considered high, then I would be cautious that this company could scale back their dividend or not grow their dividend in the near future until that payout ratio is closer to maybe a 60 or 50%. You can typically find this payout ratio figure on most websites that give you information on stocks. For example, here you can see Seeking Alpha. If you look at the top there, you can go to the dividends tab and you can see that the payout ratio is pretty much right here in the middle, and it tells you exactly what percentage the company is paying out in dividends. So regardless of your investment, whether it's a high yielder or a low yielder, this is always something to consider and always something to make note of so you don't fall into this mistake. Now the third mistake I want to talk about is something that I believe anyone can fall trap to. And it doesn't matter if you're a seasoned investor, a brand new investor, someone who's been in the markets for years. It really comes down to valuations. More specifically, the mistake I see is that people ignore company fundamentals. Now, although this mistake isn't quite as bad as the first two, especially over the longer term, it is still a mistake that I see happen and it will still impact your gains. Remember, when you're buying a stock, any stock, dividend stock, non-dividend stock, doesn't matter, you are buying into a company that sells something, whether that's a service or a product, to generate income and profits. And we're looking at a company to see if it's a good investment. You want to look at something called a PE ratio, price to earnings ratio, and this figure will pretty much give you an idea of if this company is undervalued, fairly valued, or overvalued. And like I said, this goes for any investment and any stock out there. Now, at any given point in time in the stock market, whether we're at stock market lows or stock market highs, there are certain sectors and stocks that are typically on sale and that provide excellent value because when you look at the valuation, you take the time to actually research the company, you'll see that the company is fairly undervalued. For example, right now when I'm creating this video, two companies that are undervalued in my opinion will be one from the industrial sector, 3M, and one from the sin stock sector, Altria. I personally think that the market is undervaluing these companies right now. And when you combine it with the dividend history that these companies have with the dividend growth, dividend payout, sustainability, and all these other metrics that I consider when looking at an investment, these look like very strong companies to hold over the long term to take advantage not only of their dividend growth, but also with capital appreciation. But the mistake I see is that there's a lot of investors out there that just blindly buy companies just because of the name of the company, because it's a popular stock right now, and they don't really consider or care about the valuation of this company. A good example would be Microsoft right now. You can see by looking at their metrics, they look pretty good. Payout ratio is fairly low, 5-year compounded annual growth rate is high, and they have been growing this dividend for 16 consecutive years. All three things that will actually make me very interested in investing in this stock. But when you look closer, in my opinion, Microsoft is incredibly overvalued currently. Their PE and forward PE are both above a 30, where the sector average is closer to 20, so you're paying a pretty high premium here for this company. So would I consider Microsoft a great dividend growth stock? Yes, I would. Would I consider Microsoft stock on sale currently? Absolutely not. And would I personally buy Microsoft at these current prices? I don't think so. Just because it's a good business, just because it has good growth ahead of it, and just because they're growing their dividend does not necessarily mean I'm gonna go buy this company blindly. I still have other metrics that I look at, like I discussed in this video, and right now I believe Microsoft is potentially overvalued. Now this is something that comes with time and research, a lot of time and research, and it's my personal way of investing in stocks. Not everyone's going to agree with this, but that's completely fine because there's many investing strategies out there and you should stick to one that works for you. Like I said, there are other great dividend growth stocks out there that are on sale right now in my opinion, like 3M and Altria. So those are stocks that I would prefer to put my money into right now as opposed to stocks like Microsoft. Just remember that the market is inefficient. There are always deals out there, and it's up to you to find those deals and not just blindly invest into the market, because more often than not, those massive stacks of wealth that you're after is typically done with a lot of work and a lot of research behind it. I personally would not blindly invest in a dividend stock or any stock for that matter without first looking at their fundamentals. So guys, this was actually one of my favorite videos to make because it gave me a chance to inform you better on dividend stocks and mistakes that I personally have gone through with dividend investing and that I see a lot of you going through with dividend investing as well. If you appreciate this content, all you have to do is hit that like button and hit that subscribe button down below if you're brand new to the channel. And also guys, remember, if you want to know what tools I use, for example, for stock researching, kind of find out where a company is, valuations, analysts, all that kind of stuff, my go-to choice is TipRanks. That's tipranks.com. I have a link in the description below with a promo code if you want to sign up for it. It's 20% off using positive 2019. Sign up for that. You have a 30-day money-back guarantee if you don't like the service, but in my opinion, it's actually one of the better services out there when it comes to stock research. So guys, let me know what dividend investing mistakes you've made over the years. Comment it down below, and I'll make sure to reply to every single comment down there. Thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.